Welcome, we're Ninda Dumalang Molo Sawabona Hukandat, and a warm welcome to the Andufo Knowledge Cast.
The podcast.
Yeah, the podcast where your curiosity meets insightful conversations.
That's right.
We are diving deep today
Deep.
into IAS 34.
Oh, yes.
That is International Accounting Standard 34.
For those who are not familiar.
Yes, for those who have not had the pleasure.
The pleasure.
And trust me, there is gold hidden in these pages.
There is.
Our expert is here to help us navigate all this jargon
Absolutely.
and unearth these nuggets of wisdom, so buckle up.
It's not as dry as you might think.
Okay, I'm intrigued. Intrigued.
In fact, understanding IAS 34, it can be a bit like learning the secret handshake of the business world.
Okay, I like it. But let's start with the basics.
Sure.
IAS 34, what's the big deal? Why should we care about these interim reports?
Right.
Are they just like a pit stop on the way to the main event? You know, those big fat annual reports?
You'd be surprised how much those pit stops can reveal. Think of it this way. Would you rather check your car's oil every few months? Or wait until the engine starts sputtering and smoking on the N1?
Okay.
Yeah. These interim reports are like those regular oil checks. For companies, they give us a glimpse into their financial health throughout the year.
So it's about catching those potential problems early on.
Exactly.
Before they become like a full-blown breakdown.
Exactly. And just like those regular checks can save you a hefty repair bill down the line.
Yeah.
These interim reports can help investors, lenders,
Right.
even everyday consumers make more informed decisions.
Okay, so I'm starting to see why this is important,
Yeah.
even for us non-accountant types.
Yeah.
But let's break down what IAS 34 actually entails.
Sure.
What's the gist of these rules?
At its core, IAS 34 sets the standards for what needs to be included in these interim financial reports
Okay.
and how that information should be presented.
Right.
It's all about ensuring consistency, transparency, and comparability so that anyone looking at these reports can get a clear and accurate picture of the company's financial performance.
Sounds pretty straightforward enough, but I'm guessing the devil's in the details.
You know what?
Right.
There are specific requirements for how companies should recognize revenue and expenses,
Okay.
how they should handle estimates,
Right.
what kind of disclosures they need to make about significant events and transactions.
Okay, let's unpack some of those details.
Sure.
First up, what exactly needs to be in these interim reports?
Right.
Do we need all the bells and whistles of the annual report? Or is it more of a condensed version?
IAS 34 actually offers some flexibility there.
Okay.
Companies can choose to publish a full set of financial statements, just like their annual report, but condensed.
Right.
Or they can opt for a more streamlined version focusing on the key highlights.
So it's like choosing between a full bunny chow and a bunny chow slider.
Exactly.
You get the same flavors,
Right.
just different portion sizes.
Sure. Exactly. But regardless of the format, the underlying accounting policies have to be consistent
Right.
with those used in the annual reports. No changing the recipe mid-year just to make the interim results look tastier.
So no sneaky substitutions?
No.
Okay. Consistency is key.
Yeah.
Now, speaking of making things look tasty, what about those estimates you mentioned?
Yeah.
Aren't those a bit of a gray area, ripe for manipulation?
You're right. Estimates can be tricky, especially in interim reporting, where things are more fluid and you don't have the full year's data to work with.
Right.
That's why IAS 34 stresses the importance of making sure those estimates are reasonable
Okay.
and clearly explained.
So companies can't just pluck numbers out of thin air.
Nope. Any significant changes to estimates from previous periods need to be disclosed,
Right.
along with a clear explanation of why the change was made.
Okay.
Think of it like adjusting the spice level in your bunny chow. You need to tell people if you've added an extra chili or two.
Okay, transparency is key.
Yeah.
No hidden chilies allowed.
Right.
But what about those significant events and transactions you mentioned? What kind of things fall into that category?
We're talking about events that could materially impact a company's financial position or performance.
Okay.
Think major acquisitions or disposals of assets,
Yeah.
big legal settlements, write-downs of inventory, that sort of thing.
Okay.
These all need to be clearly explained in the interim report.
So it's not just about the raw numbers,
Right.
but also about providing context and explaining any unusual bumps in the road.
Precisely. IAS 34 is all about giving stakeholders a complete and balanced picture. even if that picture isn't always perfectly polished.
It's like those reality TV shows where they show you the glamorous final product, but also all the drama and behind-the-scenes chaos that went into making it.
Yeah, I like that analogy.
I know, right?
These interim reports are like the behind-the-scenes footage of a company's financial performance.
Yeah.
They show you the good, the bad, and the sometimes ugly truth.
Okay, so we've got the basic components covered.
Right.
Condensed financials, consistent accounting policies, transparent estimates,
Yeah.
and clear explanations of any significant events.
Yes.
But this is the deep dive.
Mm.
And I'm feeling like we need to go a bit deeper.
Let's go deeper.
What are some of the more nuanced areas of IAS 34 that we should be aware of?
You're right, there's more to this than meets the eye.
Yeah.
One particularly interesting area is how IAS 34 addresses seasonality, which is a big issue for many South African businesses.
Okay.
Imagine a company like, say, a retailer that makes most of its sales during the festive season.
Like those shops that suddenly sprout up selling Christmas decorations in October.
Exactly.
Yeah.
Now, IAS 34 says they can't just pretend that December's revenue is evenly spread throughout the year.
Okay.
They have to recognize it when it happens, even if it makes one quarter look like a Bulwers roll bonanza compared to others.
So no smoothing things over to make the picture look prettier than it actually is.
Absolutely not.
Okay.
It's all about presenting a fair and accurate view of the company's performance,
All right.
even if it means acknowledging that some periods are naturally more bountiful than others.
It makes sense. So we've established that these interim reports can reveal a lot about a company's financial health.
Yes.
And IAS 34 provides the framework for making sure those reports are reliable and comparable.
Right.
But before we get too lost in the accounting weeds, I'd love to hear more about those unusual items you mentioned earlier.
Okay.
What kind of things fall under that umbrella?
Think about events that are outside the normal course of business.
Okay.
Like that freak hailstorm that smacked through Josie a few years back.
Oh, yeah.
Causing significant damage to properties.
Yeah.
Now, for a company impacted by that, it's not an everyday expense, right?
Definitely not something you budget for.
Exactly.
Okay.
That would be considered an unusual item and would need to be disclosed separately in the interim report.
Yeah.
Or maybe a company wins a massive legal settlement, resulting in a sudden windfall.
Right.
That's not recurring income, so it needs to be flagged for investors as well.
So it's about separating the signal from the noise.
Exactly.
Showing investors what's truly driving a company's performance and what's just a one-off event.
Exactly. And speaking of separating things, IAS 34 also has something to say about those segments we hear so much about in financial reporting. You know how companies often break down their business into different operating units?
Like a retailer might have separate segments for clothing, homeware, and food.
Right. If a company already discloses segment information in their annual reports,
Okay.
IAS 34 says they need to provide some key information on those segments in their interim reports as well.
So it's like zooming in on specific parts of the business, getting a more granular view of what's driving their overall performance.
Precisely. And that granular view needs to be reconciled with the company's overall profit or loss.
Okay.
No hiding anything in the fine print.
All right, so we've covered a lot of ground here. From the basic components of an interim report to the importance of disclosing those significant events, and even getting a glimpse into those all-important segments. But my brain is starting to feel like it needs a Pap and Vleis break.
I hear you.
How about we pause here for a quick recap before we dive into the nitty-gritty of how things are actually measured in these interim reports?
Sounds like a plan. Let's give those brain cells a chance to recharge before we tackle the next leg of our IAS 34 adventure.
I like it.
Welcome back.
Oh, yes.
Ready to tackle those measurement principles in IAS 34?
I'm ready to roll up my sleeves
Okay.
and get my hands dirty. I'm all ears.
Excellent. Now, one of the fundamental principles here is that interim periods are part of a bigger picture the whole financial year.
Okay.
So even though we're getting these snapshots throughout the year, how things are measured should ultimately align with the company's annual results.
So no playing fast and loose with the numbers. Just because it's an interim report.
Right.
They can't just pull a Houdini and make those pesky expenses disappear.
You got IAS 34 is all about maintaining consistency and comparability throughout the year.
Got it. Consistency is king.
Yeah.
But let's talk about those peaks and valleys we often see in a company's performance.
Yeah.
You know, those revenues and expenses that don't always flow evenly throughout the year?
Sure.
How does IAS 34 deal with those?
Ah, yes, the joys of seasonality.
I know, right?
It's a reality for so many businesses here in South Africa, isn't it?
Absolutely. Think about our agricultural sector, for example.
Yes.
Harvest time is a whole different ballgame compared to the rest of the year.
Exactly. And that's why IAS 34 specifically addresses this. It states that revenues and expenses shouldn't be artificially smoothed over. They need to be recognized when they actually occur, even if it makes one quarter look like a New Year's Eve fireworks display.
Wow.
Compared to another.
Okay, so for our listeners out there, if you're looking at a company that makes most of its money during a particular season,
right,
don't be surprised if their interim reports look a bit uneven.
Yeah.
It's all about reflecting the natural ebb and flow of their business.
Right. It's like watching the tide come in and out.
Yeah.
You don't expect the water level to stay constant, do you?
Definitely not. Now let's shift gears a bit.
Okay.
And talk about those tricky estimates we discussed earlier.
Sure.
How does IAS 34 ensure those are handled fairly? In these interim report, estimates are essentially educated guesses, right?
You're right. Estimates do involve a degree of judgment. And in interim reporting, you're often working with incomplete data.
Yeah.
Which can make those judgments even more challenging.
Right.
That's why IAS 34 emphasizes the importance of making sure those estimates are reasonable and that any changes to them are clearly explained.
So it's not just about coming up with a number. It's about backing it up.
Yes.
With solid reasoning and being transparent about any adjustments.
Exactly. Let's say a company realizes in the second quarter that their initial estimate for bad debt was way off.
Okay.
Maybe the economy took a downturn,
right,
or a major client went belly up.
Eesh, that's never a good sign.
No, it's not. But in that situation, IAS 34 says the company needs to adjust their estimate.
Okay.
And explain why in their interim report.
Right.
It's about keeping investors informed and ensuring that the financial picture they're seeing is accurate. Even if it's a bit messy.
Transparency strikes again.
Yes.
But what happens if a company needs to change its accounting policy mid-year? Let's say a new accounting standard comes out.
Sure.
Or maybe they decide to switch to a different method of depreciation.
Right.
How does IAS 34 handle those curveballs?
Good question. IAS 34 acknowledges that sometimes you need to change the game plan mid-match. But it also wants to make sure everyone's playing by the same rules.
Okay.
Essentially, any changes in accounting policies need to be reflected in the interim reports.
Right.
Either by restating the financials for prior periods.
Okay.
Or by applying the new policy prospectively.
Hold on, let's break that down a bit. What do you mean by restating the financials?
Sure.
Are we talking about going back and changing the numbers?
Exactly. It means going back and adjusting the numbers for previous interim periods.
Okay.
To reflect the new accounting policy. Think of it like revising a recipe. If you decide to add an extra cup of sugar to your cake batter, you need to adjust the sugar measurement for every slice you've already baked.
Yeah.
Otherwise, you'll end up with some seriously inconsistent sweetness levels.
That makes sense.
Yeah.
So you're essentially rewriting history to ensure everything aligns with the new rules.
Exactly.
But you also mentioned applying the policy prospectively.
Right.
What's the difference there?
Sometimes going back and restating everything just isn't feasible.
Yeah.
Maybe the information is lost in the annals of time.
Right.
Or digging it up would cost an arm and a leg.
Yeah.
In those cases, the new policy is applied prospectively.
Okay.
Meaning from the date of the change going forward. It's like saying, okay, from now on, we're doing things this new way and leaving the past in the past.
So it's like drawing a line in the sand and acknowledging that sometimes you just have to move forward.
Right.
With the best information you have at the time.
Exactly.
But regardless of whether they restate or apply prospectively, the goal is to ensure consistency and comparability, right?
Precisely. ISS 34 doesn't want to see companies flipping accounting policies like pancakes.
Okay.
It's all about creating a level playing field so that investors can compare apples to apples, or maybe nartgies to nartgies in our case.
I like it. Now, what if a company changes its accounting policy after the last interim period, but before the year end? Do they need to go back and revise their interim reports?
That depends on the significance of the change.
Okay.
If it's something major, IAS 34 says it needs to be disclosed in the notes to the annual financial statements.
Right.
But it doesn't necessarily require them to reissue their interim reports.
So it's more about making sure that the information is captured somewhere.
Right.
Even if it's not in the original interim report itself.
The key is to ensure that investors have all the relevant information. They need to make informed decisions, including any changes in accounting policies that could affect the company's financial performance.
Got it. So we've covered the need for consistency in accounting policies.
Yeah.
The importance of handling seasonality and estimates properly.
Right.
And even the complexities of changing accounting policies midstream.
Yes.
It's all starting to come together now.
You're getting the hang of it. And it all ties back to the overarching goal of presenting a true and fair view of a company's performance, warts and all.
Exactly. No sugarcoating allowed. But before we move on to the final leg of our IAS 34 journey, I think it's time for a quick pit stop to recap all those measurement principles we've covered. After all, too much accounting jargon can make anyone's head spin.
Agreed. Let's give those brain cells a quick water break. Before we dive into why these interim reports are so important for all of us, not just the number crunchers out there.
Welcome back to the Indubo Knowledge Cast. We've trekked through the dense bush of IAS 34.
Yes, we have.
Explored its winding rivers and scaled its towering mountains.
We've emerged.
And we've emerged.
With a newfound appreciation.
Yeah, with a newfound appreciation for the power of interim financial reporting.
Haven't we?
Yeah, I'd say so. But before we celebrate with a celebratory castle light, I have one burning question.
Okay, shoot.
Why should the average South African, you know, the person on the street, care about all this accounting jargon?
Right.
How does IAS 34 actually impact our daily lives?
It's all about making informed decisions. Whether you're a seasoned investor with a portfolio thicker than a phone book, or just someone trying to make sense of the companies you interact with every day.
So it's like having a secret decoder ring for the business world.
In a way, yes. These interim reports give us those valuable insights, helping us understand the companies we're investing in, doing business with, or even just following in the news.
Okay, think about it like this. Would you rather know how your favorite soccer team is performing at halftime, or wait until the final whistle to see if they've won or lost?
Exactly. Interim reports give us those crucial halftime updates, letting us see the game as it unfolds, not just the final score.
Hey, that analogy makes sense. It's not just about the numbers.
Right.
It's about understanding the story behind those numbers.
Right. And that story can be very insightful.
Okay.
By tracking a company's performance throughout the year. We can spot trends, identify potential red flags, and maybe even uncover hidden opportunities.
So if I'm thinking about buying shares in a company or even just deciding whether to support a particular brand, these interim reports can give me a better sense of whether they're on the right track.
Absolutely. They offer a more nuanced perspective than just waiting for the year-end results.
It's like getting regular progress reports on a student.
Yeah.
Instead of just seeing their final exam grade, you get a much clearer picture of their strengths, weaknesses, and overall trajectory.
Perfect analogy.
Yeah, I know, right?
And because these interim reports are governed by IAS 34, we know that the information is presented in a consistent and comparable way, regardless of the company or industry.
So it's like having a standardized measurement system, like those measuring sticks they use at the taxi rank to make sure everyone's luggage fits in the boot.
I love that. You're right. It's about ensuring fairness and transparency across the board.
All right, so we've decoded the mysteries of IAS 34, explored its nooks and crannies.
Indeed.
And even had a good laugh along the way.
We did.
But before we wrap up,
I'd
love to get your take on the future of interim reporting.
Okay.
With technology evolving at lightning speed and access to real-time data becoming more and more common, do you think these reports will become even more important in the years to come?
That's a great question. And honestly, I think the answer is a resounding yes.
Really?
In a world where information is constantly flowing, investors and other stakeholders are going to demand even greater transparency and more frequent updates on a company's performance.
So instead of just those quarterly checkups, maybe we'll be seeing monthly or even weekly updates.
It's entirely possible. And with the rise of artificial intelligence and data analytics, we'll be able to extract even more insights from those reports, helping us make even more informed decisions.
Wow, that's a fascinating thought. It sounds like the world of financial reporting is about to get a serious upgrade.
It certainly is. And with IAS 34 as our guide, we'll be well equipped to navigate those changes and make the most of the information at our fingertips.
Well said. This deep dive has been truly eye-opening.
My pleasure.
Who knew interim financial reporting could be so relevant and even, dare I say, exciting?
The pleasure was all mine. Remember, knowledge is power.
Hmm.
And understanding IAS 34 empowers us all to make better decisions in our personal and professional lives.
Well, that's it for this episode of the Indubo Knowledge Cast. But before we say goodbye,
Okay.
we want to leave you with something to ponder. As access to information continues to grow, what role do you think individual investors should play in holding companies accountable for their financial reporting?
Ooh, that's a good one.
Let us know your thoughts on our social media platforms. We'd love to hear from you. Until next time, stay curious and keep those brains ticking.